Over 1 million people around the world follow Wall Street veteran Mark Chaikin for his shockingly accurate stock market predictions, and he just gave them a dire warning. Mark says we're about to witness a historic stock market shakeup that could soon create devastating losses for investors who don't know what's coming. And as a result, you only have 90 days to move your money. You see, Mark spent 50 years on Wall Street at some of the most prestigious hedge funds in history, and he's been on Fox Business and CNBC countless times. But this is a financial story no one else is telling. And if you let this take you by surprise, you could be in for a world of pain. He explains everything in a brand new free report available at rollingcrash.com. He includes the name and ticker of a popular stock that could be directly impacted by what's happening as well. Mark warned of beloved pet brand Chewy before it fell 45%, tech company C Limited before it fell 66%, furniture company Wayfair before it fell 76%, social media favorite Snap before it fell 36%, and food delivery company DoorDash before it fell 65%. Mark even called the Amazon crash before the famous FANG stock fell 35%. So you'll want to avoid the stock in his new report immediately. Again, simply go to rollingcrash.com for your free copy of this new report. Hi, this is Daniela Cambone. Welcome back to the Daniela Cambone Show. In studio today with my guest, Joel Litman. He is the president and CEO of Valens. He's also the chief investment strategist over at Altimetry, part of the Stansberry Research family.
That's right.
Joel, welcome to New York City. Awful air pollution and all, but welcome.
Yeah, I know. It's crazy to think to see this smog come in like this, but thanks. I'm happy to be in New York anyway, and I get to be in studio with you.
Yeah, well, lots to talk about today. Obviously, want to get your thoughts on what you think the Fed will do next. This June meeting, highly anticipated because will they pause? Will they not? What will they do? Have they managed to tame inflation? Why do I think you have a very strong opinion when it comes to this?
I think the Fed is a two-punch boxer, and one punch is for unemployment, and they don't need that punch anymore. And the other one is for inflation. I think they still think they need it. So as long as they need this one for inflation, I don't see they're going to be super accommodative and back into QE anytime soon, because they really haven't killed the inflation issue yet. And I think they still need to keep doing it.
Okay, so inflation is an issue for you. Still an issue.
It's single digits. It's limited relative to the rest of the planet, but it's bad enough in the States that I think the Fed will have to still continue to fight it the way they think they should be fighting it. So right or wrong, I think we still see a non-accommodative monetary policy from the Fed.
Are we headed into a recession?
Yeah, I think all the signs are there for a recession coming. I think it's going to be a mild recession. I don't think it's going to be anything like the great financial crisis 2008. I don't think it's going to be like it was in the early 90s, in 91, the savings and loan crisis, which people compare it to because of the regional bank issues. But there's definitely credit issues. Our official dollar cost averaging is, while we are long-term still very bullish on the U.S. equities and U.S. market, is to dollar cost average over 24 months. So that's probably as long-term bullish and still short-term, near-term bearish as you could be.
Lest we forget, because the last time you were on with me, you took a lot of heat for your very bullish calls on the U.S.
Yes.
Okay? Yeah. And you actually called me up and were like, I need to come on your show again. And I said, you want more punches? You're like, bring it. Because you've seen a lot of experts come on my show talking about de-dollarization, how it's the end of the road for the U.S. dollar. And you were like, enough. So no. I want to give you space to make your thesis of why you think this is not the end of the road for the U.S. dollar. In fact, it's going to keep going higher.
Yeah, I think the de-dollarization talk is based on anecdotal and sometimes hopeful ideas that aren't backed by data, and that's it. I mean, if you have the right data, you see things differently. So right now, one of the things they say is the BRICs, right? Brazil, Russia, India, and China. So first off, China's actively managing their currency against the dollar on a regular basis, right? The Hong Kong dollar is still pegged to the U.S. dollar. The renminbi is still manipulated massively, partly because China's worried about what happened to Japan, where the yen got so strong, and they lost a decade of the economy in Japan. So China's worried about that. And you think India and Russia and Brazil are going to turn over their currencies to whatever China wants to do with theirs? I don't see that happening. India and China are in armed conflict right now over Pakistan-owned Kashmir, which India still thinks is theirs, and China's been backing Pakistan like crazy. So I don't know if people realize there's 250,000 troops facing each other with active skirmishes in the last, and suddenly India's going to say, we're going to turn our monetary policy over to China and let them decide what happens to us?
Okay.
I don't see that happening. It's silly.
Fair enough.
Silly.
Fair enough. Okay. Let's break it down. And by the way, did Hugh Hendry call you? If you saw the interview, you'll know what I'm talking about. Anyways, okay, because he also is like you and thinks that it's just not going to happen. Actually, he wants it. He would want it to happen because he feels that the U.S. dollar is just keeping other countries impoverished. So he's actually said he would beg for the day that the U.S. dollar dies. Well,
I pray on my knees every day for the end of the U.S. reserve currency.
Well, that's the issue of the hope, right? So it's a question of do you want it to happen or what will happen? What will happen is the dollar remains strong for the next few decades.
Let's hone in on the BRICS because they just finished their summit in Cape Town, a precursor to the big thing that's happening in Johannesburg in August. Mm-hmm. So I get the argument that people are like, okay, no one wants to trade in bolivars or rubles, like who cares? But the point that they're trying to make with the BRICS is that they're gaining momentum. They're getting more countries, right? More and more countries joining forces. And maybe it's not China convincing people of their monetary policy, but collectively, they would have a new reserve currency.
Yeah. So the reason why it's silly is because first, I don't think it's going to happen. But second, let's say it happened.
Yeah.
So let's say they agreed on this new world crypto whatever currency that they get together and manage, which isn't going to happen. But let's say they did. What would each country do with that money, whatever that money is, the next day? So if they're going to invest it and they want a good dividend, they're going to have to put it somehow in U.S. stocks because more than half of global profits are earned by U.S. corporations. So unless you're ready to give up all your dividend potential, which is from the U.S., you can't invest in U.S. stocks. So let's say you have the currency. What are you going to do with it? You're going to put it into U.S. dollars so you can buy U.S. stocks because you can't with this strange new currency they're going to never invent anyway, but even if they did, what would you do with it? If they want income, the only place to go is the United States. I'm not saying that other countries don't have bonds, but if you want rule of law, where you put money into a bond, and by the way, unlike in China, where if they default on a bond, you don't get paid back, right? And you can't go after bankruptcy because they don't have those kinds of rules there. Can you imagine a foreign company sending a Chinese company in bankruptcy because they defaulted, like Evergrande? So no, they just stop paying their bills, right? Whereas in the U.S., if a company doesn't pay their bills, doesn't pay their principal and interest, foreigners or whoever can go after the company and put them in a bankruptcy. So that rule of law says if you want income, you've got to go to the U.S. If you want risk-free rate, the U.S. is the only place to go. The reason why China has $800 billion sitting in U.S. treasuries isn't because they're trying to support the U.S. It's because why don't they put it into Chinese companies or Chinese localities or municipalities? Because they're worried not going to get the money back. The reason why even China puts $800 billion into a U.S. treasury is because there's nowhere else to go.
Do you think that could it be plausible that they would want to overtake the U.S. dollar as the reserve currency?
Of course they want to, but it's impossible. It just can't happen.
You never see the end of the U.S. dollar. You don't see this empire ever falling?
Not in our lifetime. Yeah. So what it comes down to is because the U.S. underlying economy, despite everyone saying what's happening right now, and I do believe there's going to be some near-term issues with regional banks and the shadow banking system is going to have some problems, and I think there will be tightening credit, which will create a slowdown, and I think we'll see 2023 earnings, uniform earnings, right, using clean accounting, not the stuff that Wall Street puts out, will still be lower than 2022, so that's going to take a hit. But over the long haul, every entrepreneur wants to be in the United States. Every business wants to be in the States. The U.S. has the best micro cap, the best small cap, the best mid cap, the best large cap environment. And so when you go everything from angel investing and VC investing and the whole thing, every entrepreneur wants to build in the U.S. That's what brings the U.S. its strength and the strength of the dollar.
The argument that proponents of de-dollarization will bring up our debt levels. So debt prior to third quarter of 2008, GDP ratio was 63%. Today we're over 120%. Prior to 2008, the Fed balance sheet was $500 billion. Today we're 18 times that. Mm-hmm. So what do you say to the folks that are like, the debt, look at the debt that we're in?
Yeah, I'd say they haven't done proper credit analysis. I'm just being blunt, right? So when you do credit analysis, you don't look at debt to GDP. I know other people do. I think it's wrong. No country pays its debt with GDP. They pay their countries with taxes. So if you understand where taxes are going, right, in the U.S., last year the U.S. collected $5 trillion in taxes. $4.9 trillion in taxes. What was the debt service last year? Not barely even 500, 600 billion. If someone came to you and said, Danny, you're making $500,000 a year.
Yeah.
You're making $500,000 a year after tax. That's your take home.
Yep.
And your total debt service is $60,000. Would anyone say you're not AAA? Everybody would say you're AAA. This is why the U.S., every time it raises, it says we want treasuries, the whole world says we're happy to take it at your interest rate because they know it's going to get paid back. That's why the U.S. is still AAA. I know one of the agencies might say they're AA, but that's nonsense. If there's anybody that's AAA in the world, it's the U.S. And the reason is because they have more than enough money to pay their debts. I think the politicians have been absolutely irresponsible. But they've been bailed out by the strength of the U.S. economy.
Fiscal Responsibility Act, right? Where's the responsibility?
Yeah.
And I'm glad you brought up the tax collection, okay? Because what the heck did they do with all that money? And why did we find ourselves in the debt ceiling debacle again for it to be kicked down the road? What are they doing with the money?
I think the politicians still grossly overspend, and their problems and their addiction is getting bailed out by the strength of U.S. businesses and U.S. household wages, which keep going up. They have. And so what's amazing is that the U.S. on a lower tax rate, meaning China grossly overtaxes its citizens, Russia grossly overtaxes its citizens and its businesses, which is leading to this very, very slow, not to mention the Russia-Ukraine, but even without the Russia-Ukraine war, Russia grossly overtaxes people, and so does China. Whereas the U.S. on a lower tax rate collects so much more in tax revenue because of the strength of businesses. It's the businesses bailing out the politicians' irresponsibility.
I want to bring this up because besides being a world-renowned economist, you were also an advisor to the Pentagon.
Yes.
What keeps Joel Litman up at night when you're looking at things on a global level? What's a main concern for you?
A repeal of the Bill of Rights. The reason why, I'm just being blunt, the repeal of the Bill of Rights and all game off, right? I mean, for the U.S. As long as the Bill of Rights is in place and enforced, right? And I'm being specifically 1, 2, 4, 5, 6, 7, and 10. Then you're like, what do you mean by that? You can't have free thinking entrepreneurship without free speech. So the idea that China's entrepreneurship is ever going to be as efficient, first off, U.S. venture capital is more than the entire rest of the world combined by double. There's a reason for that, because every person says in the U.S. with venture capital, I have a chance at getting rich, and the government can't just take it away from me. Right? You can have a Tesla fight GM and say, we're going to be bigger than GM. It happens. That doesn't happen in other countries. That doesn't happen in China. When Jack Ma said, I've built Alibaba, now I'm going to go after banks, someone made a call to Xi Jinping and said, oh, no, he's not. He's not taking us out.
Yeah.
And suddenly Jack Ma goes in a hotel prison for 3 months and doesn't show up anywhere. And now people joke that is it even really him anymore because he doesn't speak? It's like his tongue got cut out, right? That doesn't happen in the U.S. So because of the Bill of Rights, as long as those are in place and every other country doesn't have as strong 1, 2, 4, 5, 6, 7. You can't just be put in jail for no reason, right? You can't, and states' rights, which means there's no real U.S. national police force. Biden can't just say, hey, I don't like you, and suddenly the police show up at your door, right? The FBI doesn't have enough people to do that. So they can't do this. So what I'm getting at, as long as that's in place and other countries don't have it, entrepreneurs want to be in the United States, businesses want to be in the United States, and those businesses produce the tax power the U.S. has.
Which makes me want to bring up the SEC and crypto now.
Yes.
Your take on the SEC looking to now regulate. Why the sudden awakening now? What do you make of the timing of this? Is there anything linked to central bank digital currencies?
I think the SEC was a little bit undermanned, is a nice way to say it, right? They're under workforce. They don't have enough people for doing all the things they have to do, right? They're not able to police companies sufficiently. We say this all the time, that if you're in the microcap world, you can't rely on the SEC to catch bad companies.
Why can't they just hire more people?
They don't have the budget. They don't have the people. They don't have the time.
The SEC doesn't have the budget.
They do not have the budget to go after microcap companies. One of my favorite products are small cap and our microcap product. And the reason that we're very good there is because, in speaking stocks, is because we're able to very quickly say, don't touch these. Our do not buy list has a negative 50% return within 9 months of a company ending up on our do not buy list because the SEC is not doing their job. Not in anything below $1 billion, $2 billion. They don't even look at these companies.
But
they file, but they don't.
But they're now looking at crypto, right? What's any thoughts on what? Like, are you staying out of that space completely now?
No, we have to watch it. I think as an economist, I have to watch it. I think the SEC has been late to the game. I think they're trying to show that they're catching up. I don't know that Coinbase and what they're doing there is the right place to go, right? They missed on FTX. They missed on some of the others. So, my hope is that whatever comes out of this, that there'll be some actual case law, right?
Okay.
And from that, we'll actually have a good crypto environment in the United States. What we don't want to do is lose it because the U.S. just says, the SEC says, oh, we don't like it at all. And then Hong Kong and all these other countries get crypto and we don't have it.
Right,
so
exactly.
Hopefully they'll be out of this. I just don't know how heavy the SEC is going to go after Coinbase or anybody else.
Well, because that's what I was saying. Like CZ could just be like, all right, okay, I'm regulated in the U.S., I'm out of the U.S., right? Okay, sectors that Joel Litman likes right now. You obviously like U.S. equities.
Yeah, I like U.S. equities long term, dollar cost averaging over 24 months. All right, so it doesn't mean buy in, don't jump in right now because we think it's going to be a really choppy 6 to 24 months.
But specific sectors and equities.
But sectors that we really like,
yeah.
I like anything that has to do with the supply chain super cycle. Meaning the idea that companies are trying to de-risk having too much of their supply chain in China or in foreign places, and the nearshoring and the onshoring that's happening is going to lead to, I think, some really, really good opportunities in there. I think when you look at our best long idea, our conviction long ideas across large cap, small cap, and micro, you're going to see things that are powering the cloud. You're going to see things that are powering data, that are powering the new supply chain of the U.S., which cuts through many, many different sectors. So it's hard for me to say I like one sector.
Right. So, like, what would you do with those tech stocks that were just absolutely destroyed? Like, are there some you would stay away from, or do you think there's renewed hope for some of those?
You know, in the big large cap names, it's so, I'll say, money fund oriented, meaning just fund flows oriented. The favorite ones we like, one of the ones that I mentioned on May 10th at one of our programs was SMCI, which is Super Microcomputer. And the reason we liked it because they are powering the cloud, but it's also a smaller company, right? I bet a lot of listeners have never even heard of the company. No. Those are the ones we really like. Because, you know, trying to make a bet on Facebook and all the people going up and down or trying to make a bet on Tesla.
How about Apple?
Or Alphabet. Yeah. Even on Apple with the Apple Vision, right? At $3,500, hard for me to say is that going to do well or not, right? But if we could find the suppliers of Apple, if we find the suppliers of those tools, and we focus on those companies in the sub $5 billion, sub $1 billion, that's where we find some of our best ideas.
Do you like commodities?
No, I think there's enough of a global slowdown that what you've seen across aluminum, across copper, across nickel. I mean, it's not the crazy bear market it went into, right? But there's been some rebound. But I'm not saying I'm buying there. I don't love it.
And you're obviously long U.S. dollar.
No. There isn't. First off, there is no fiat currency that's a good currency to invest in. Okay. Right? No. I mean, but as a medium of exchange, the U.S. dollar is going to remain the reserve currency for the next, several decades, as long as the Bill of Rights stays in place.
Would you be buying treasuries here?
I'm not a big fan of most of the bonds right now. Not yet. I think we're still going to have a credit fallout. And when that happens, I think we're going to see some bonds really get punished. And later this year, early 2024, we'll probably come out with some really good bond ideas because of it.
So more banking consolidation. I mean, Janet Yellen's warning about it now. She changed her tune, saying before, banking sector was healthy, but now she's warning us that we could see more consolidation with the banks.
Yeah, I mean, there probably should be. I mean, there's thousands and thousands of banks. People talk about Signature Bank like they know it. I'm like, which one? There's 5 Signature Banks. There's Arkansas, there's Toledo, Ohio Signature Bank, there's Chicago. And people thought it was the Chicago Signature Bank that wanted it. So I'm like, first off, there's so many thousands of banks. There probably is some room for some healthy consolidation in that.
All right. Yeah. I'll give you the final word. Bring it home for us, Joel. Final thoughts for investors watching, navigating these, would you say, troublesome times?
I think it's going to be very troublesome, choppy next 2 years, but not so much that we wouldn't still be buying in. So we love U.S. equities. No other place in the world do I love as much as U.S. equities, and that's what the data would say. I love it because the data would say that.
Oh, boy.
I would just leg in over the next 24 months. I think it's going to be a tough 24 months, and I think we're still going to have the recession, and it's not going to be pretty. And it's going to take a little longer than people think to work out all the shadow banking stuff. It's not as easy as a Lehman or a Bear, and you just have to restructure.
Right.
Yeah. And I say that is easy. I think the shadow banking is big, and it's going to take a while to work out. Yeah.
All right, Joel Litman, everyone. Thank you so much for stopping by.
Thank you, Danny.
Come back more often. And thank you for watching. We'll have more great content headed your way, so be sure to stay tuned to the Daniela Cambone Show and sign up at danielacambone.com so you can stay on top of all these great interviews like Joel here on Stansberry Research. Thanks for watching.
Thank you.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.